What if I told you the best performing AI company last year isn't NVIDIA, it isn't Microsoft. It's a company you probably associate with the SD card in your old digital camera. This is Sandisk. In the last year, this stock has ripped up over 1,700%. It is currently trading at $660 a share. And yet, if you turn on the news or read analyst report, you keep hearing the same thing. It's a bubble, it's cyclical, or the party is over. But today, we're going to look at the raw data, specifically their Q2 2026 earnings report that just dropped, and comparing it to what the smartest analyst on Wall Street thought was going to happen. We're going to prove that Sandisk is the black horse of the AI revolution. Even the bulls are underestimating the company by billions of dollars. We're talking about a disconnection between spreadsheet reality and AI reality. If you want to understand why a boring storage company is suddenly guiding for profits that rivals big tech monopolies, stick around. You need to see these numbers. Let's start with the expectation gap. Before the earning report dropped, the top firm on the street maintained the overweight ratings. They liked the stock. They thought they were bullish. I looked at the internal reports from top-tier banks heading into this report. They modeled revenue at $2.61 billion, and that was being optimistic. Sandisk just reported $3.03 billion. That's a massive beat. But revenue is boring. Let's talk about profits. This is where the Wall Street model completely broke. The smart money models predicted earnings per share of $3.29. They thought Sandisk was recovering nicely, and Sandisk actually reported $6.2. They didn't just beat the estimate, they nearly doubled it. That represents a 408% increase in profitability in a single quarter. But here's the drop the mic moment. This is the specific data point that proves Wall Street have no idea how fast this is moving. We need to look at the guidance for next quarter. The analyst was looking at their historical charts, the old memory cycles, and they predicted that in Q3, Sandisk would make about $3.64 per share, and that the growth would be gradual. And in their earnings report, Sandisk's management came out and said, no, we expect to make between $12 to $14 per share next quarter. I mean, just look at that gap. The professionals predicted $3 and they're actually getting $14. That is a 4x discrepancy. In the financial world, you rarely see a miss that big. This isn't a calculation error. This is a fundamental misunderstanding of the business model. So how does a company beat estimate by 400%? It's because Sandisk isn't selling SD cards to photographers anymore. They're selling the basement of the AI skyscrapers. According to Bank of America, a massive shift happened at CES in Las Vegas this year. NVIDIA's CEO Jensen Huang unveiled new chip design to handle larger context windows. In simple English, AI models are getting too big to fit inside the expensive processor chips. They need to store data on slightly slower but much cheaper chips, NAND flash, and pull it instantly. This is called inference. Sandisk is the king of NAND. In their earnings report, they revealed that data center revenue is up 64% quarter over quarter. Their CEO explicitly said this demand is coming from AI infrastructure builders and customers deploying AI at scale. Wall Street is treating Sandisk like a commodity company, like a farm selling corn. If there's too much corn, the price drops. But right now, Sandisk is selling the only corn that works with the NVIDIA engine. Look at the margins. In Q1, Sandisk's gross margin was 29.8%. In Q2, it hit 51.1%. And for the next quarter, they're guiding for 65 to 67%. Commodities companies do not have 67% margins. Software companies have 67% margins. This is telling us Sandisk has incredible pricing power because there is a shortage of high-end enterprise SSDs. Now, I want to play devil's advocate, because despite this rocket ship performance, there are smart people betting against this stock. That was an analyst on Yahoo Finance who has the equivalent of a sell rating on the stock. His argument is the classic cyclical bear case. His argument is high prices kill high prices. Sandisk is making a fortune right now, so they'll build more factories. Eventually, by 2028, there'll be too many chips and the price will crash. And historically, he is right. That is exactly how memory works. But why is Sandisk the black horse that breaks the rules? In previous cycles, demand comes from smartphones and PCs. That growth has slowed. Today, demand is coming from a global arms race to build AI data centers. The demand isn't linear, it's exponential. Furthermore, I looked at the institutional research notes on the supply chain. They noted that investment plans are unchanged. Sandisk and its partners aren't flooding the market with new factories yet. They're keeping supply tight to maximize profits. The skeptics are waiting for a crash in 2028. Meanwhile, this company is printing $14 in earnings per share right now. If you annualize that, this company is trading at a PE ratio that is surprisingly low compared to other AI high flyers. So here's the bottom line. Wall Street underestimated Sandisk because they were using an old playbook. They looked at spreadsheets from 2023 to 2024. They didn't account for the fact that AI inference would turn NAND storage into a critical high-margin component. When a company guides for $14 EPS when the street expects $3, that's a signal the information gap is still huge. The black horse has already left the stable. The question isn't whether Sandisk is an AI play, that is proven. The question is, how long would it take for the rest of the market to realize this cyclical stock might be in the first inning of a supercycle? What do you think? Is Sandisk a bubble waiting to burst in 2028? Or is it the most undervalued AI stock left? Thank you for watching. Don't forget to like and subscribe for more of these videos. I read the boring numbers so you don't have to. And I hope to see you in the next video.